90% goes to S&P index funds.
You got to double your
10% straight to
investment.
Is 20th Century Advice driving your 21st century portfolio? tastylive has joined forces with the CME and SIBO to offer the industry's first multi-exchange trading collaboration. Our new live event, Building a Complex Portfolio, puts active traders on the path to modern portfolio creation. Tom Sosnoff and other tastylive personalities will cover strategies that'll help you integrate futures and options into your portfolio. Sign up at tastylive.com/events and see where we're headed next.
Morning, Uncle Craig. I really appreciate all the investment advice you bestowed upon me this holiday season. That opportunity Prince Harry emailed you about sounds interesting, but I think I'll just stick to watching tastylive.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
I don't kick the cat or the dog or the small children until the day of Christmas.
From the smart mouths at Tasty Live.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
If you missed the live show, here's our cherry on top weekly recap.
First of all, I'm sitting in the captain's seat. I've never been invited to come sit in the new captain's seat. But what I'm concerned with is the size of these screens. And he's still doing this.
Snow, let's take a look.
They did not hold that rally at all.
Phil, you got a partial. 973.75.
I'm looking at this like I have to move my head to get through the top, the top symbols. I thought he had like a little computer and he was getting down.
He hasn't learned that he could like swivel his head. He has to see the screen. He has to go like this.
To me. And then, you know what? Money goes to money. You did it. Good job out of you.
Yeah.
I just drove with him twice. Now I'm really concerned that I was just in the car with him for 2.5 hours.
How much does it cost you guys to do simultaneous hair flips?
Years of practice.
Everybody wanna be like me, yeah.
If you missed the live show, here's our cherry on top weekly recap.
You know what my first concert was but when I was very young. It's quite embarrassing.
Anson.
How'd you know that?
I mean, I feel like everybody.
How did you know that?
Because who else was popular then in like the late 90s?
Oh my God,
that's amazing.
That was cringe. There it is, the song, yes.
Yes. All right, good luck, good trading. Let's go eat some roost.
Peace.
Thinkorswim will always be my baby, but this one, it's different. We built ours literally from scratch. It's a much thinner, it's a faster, it's a slicker application. Everything's on one page. So you're always looking at the core page and then bouncing around from there to get to whatever you want to get to. We're here to support whatever you're looking to do. We have the tools that you need to be a successful trader.
Oh, yeah. It is Monday, September 30th, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's evening show, a little podcast called The Price of Truth, where we like to explore the incentives that govern our world. It's normally simple. We have great minds come on and share great ideas, but we are riding shotgun and we are solo today, which means it's a participatory show, and it's the first show where we're actually going to have extended hours going forward. So if you remember, I think we started off at like 30 or 45 minutes. We upped it to 60. Now we're upping it to 90. So we're going to go 90 minutes straight. I don't know if you guys are ready for it, but I sure as hell am. I'm excited to see all of you. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't have both of them, make sure you go get them. But if you want to be part of the conversation, there is only one place to do it, and that is on the evil Google YouTube. So hop on over to YouTube, type in Tasty Live, go to the live segment, go to the live tab, find my face on a thumbnail, my big inflamed head on a thumbnail somewhere, jump in and start typing in random ass characters. Why do we type in random ass characters? We want to spoof the Google algorithm. The more active you are in the chat, the more they're going to put this video in front of people. And the whole idea is to save the world one view at a time. Speaking of the people, this is a show by, of, and for the people. We should say what's up to the people. What's going on? YouTube chat. Brian Thornton, I see you. Cato Prime, what's up? Absolute Beginner Loan, great to see you back here. VW. VW. Who says W that way? You can tell part of the country I was born in. Cactus Leo. Jay Wright, what's going on? My living room music. What do you guys listen to? I'm kind of curious what kind of music you guys are into. You know, I'm starting to get to that age where, you know, every sort of generation goes through that like 30-year-old phase where you listen to new stuff and you go, I don't get it. What are you guys talking about? You know, I throw in my old tapes. What's up? Why not? Jazz, Kimberly Thomas, great to see you. Rezo, Sterling. I would love to just sit here and shout out everybody's names, but they tell me I'm not allowed to do that. So unfortunately, I'm going to have to actually say something of a little bit of substance here. But I just want you to know I would like to just shout out all of your names. However, you'll notice all your names are streaming on screen. So say what's up to the people if you want to. Be respectful, so we can keep the stream up, but have some fun at the same time. We got a lot to talk about. We're going to set up the week that was, a little bit on last week, talk about what to expect this week, some decent earnings around the corner, a handful of them that are worth, I think, discussing. The economic calendar. The Fed squawking has not stopped. You're going to hear a bunch of Fed squawking again this week. A little bit about the hurricane impacts so far, a little bit about the port strike that seems to be on its way here, and a handful of other things. Some nuclear. I want to talk China a little bit, these Chinese stocks, what to do at these sort of price levels. So we got a lot to talk about, and we're going to have a lot of fun. So do me a favor, hit the like button, and let's get this place rocking. What did you guys say? I played my guitar for an hour today. That's what I'm talking about. Play some real music. Let's get back to that. You know what I mean? So we got a lot to talk about. Let's get going. Powell zigged and the market zagged. Yeah. They just can't help themselves, can they? But it ended up just being short-term opportunity. Let's get going here. Let's talk a little bit about what to expect this week. No. Let's set up last week. So coming into the week, we had the NASDAQ up a little over 1%, 1.1% to be specific. In the NDX, the S&P last week up about 2/3%. All S&P sitting at and making new all-time highs. The NASDAQ not necessarily close to that sort of 21,250 level. The Dow Jones was up around 0.2%, and the Russell was up about 0.5% as well. So a bit of I would say, a bit of a digestion week last week, and you definitely got the yield curve last week. We moved through around 26 basis points. We had steepened up to 26 basis points. That was the maximum pressure that the long end of that curve basically lifted, or the highest rates were about Wednesday is when we expanded all the way to 26 basis points. Thursday, you got basically a reversal in the yield curve, meaning the long end rates started to ease last Thursday. And in my personal opinion, that helped ease and helped fuel the NASDAQ rally that we saw on Thursday. Just taking a quick look at the yield curve, everybody, so you can sort of see what this looks like. Typically, we're just focused on the 210s, but you can see those shorter term maturities are still paying, 5%, or between 4 and 5%, all the way up to Fed funds futures at 5%. And we've been watching what we believe, or what I believe is likely to happen. And we saw the first part of this. When you start easing the front end, or the Fed funds futures, Fed funds rate, the market's going to have an expectation that that's potentially inflationary, and it seems the Fed is trying to execute that at the exact same time where global growth data is easing. Why? Because if global growth is easing, there tends to be an increased demand for bonds. Well, I don't say this is why. This is my interpretation. So in an environment with increased demand for bonds, you start to lower your Fed funds rate, which is then going to increase the yield on the longer term securities, because people are sort of nervous. Hey, this is going to cause a reacceleration of inflation. But on the other hand, you've got the demand for bonds that are increasing, because you've got sort of this global slowdown, and perhaps that will keep a lid on the upward pressure, or the upward direction of the long end yield curve. And I think we're gonna watch as effectively they continue to take down short rates, and that long end rates continue to tick higher, and we just continue, I think, to see steepening. If the best case scenario plays out, right? If you don't run into some sort of credit issue, if you don't you don't have this massive geopolitical escalation that might play itself out. In the best case, ceteris paribus, I think you continue to ease the short end, and the long end just continues to rise. And that's how we get out of this thing, and we end up in a steeper yield curve that's more accurately priced for U.S. credit risk. But sometimes the best intentions aren't exactly where you end up, right? You might have great plans for where you're trying to take this thing, but there's a lot of risk along that journey. So we continue to watch the long end of the curve. Last week, as we got closer to 125 in the bonds, we got down to like 124 and change. You can see it here. I closed out a lot of the short deltas in ZN and ZB. I just think this is going to be a little bit of a congestion area at 124. It was previous resistance. The likelihood that it becomes some sort of short-term support, I think, is high in the short term. And so I kind of want to give the market a little bit of time to digest and pick a direction here. Who knows? We might just trade sideways. So I didn't think the risk to reward favored having a directional opinion anyway in the long end of the curve here, ZN and ZB. But that's sort of the lay of the land for how we come into this week off of last week, why I think the yield curve was fundamental into the shifting yield curve played into risk assets, in particular on Thursday when you saw the reverse basically flattening. So we had steepened up to 27 basis points. We ended the week at 20 basis points. And that's the difference between 2-year yields and the 10-year yields, which is now positive as we've moved out of inversion. And that we had steepened up to 27, 26-ish, and we came back into 20 at the back end of the week, lowered yields. All else equal, is bullish for long duration securities. So technology, lots of high beta instruments, and I think in some ways that's sort of fueling that increased risk appetite. Part of it. Let's see here. ZB Gravity for a place to add to an existing position to start a new one. Yeah, so I'm flat in the long end, and we'll look for opportunities here. Hopefully, I'd love to see them rally them back up to 126-ish and be able to start adding new short delta positions. I just don't love the risk and reward here at 124. Beyond the majors, the big stories for last week are, sort of we're seeing the reversal of that today, which shouldn't really surprise a ton of people. Because you got to imagine, right? Like last week was a gigantic week for materials. It was the outperforming sector. It was up 3.5%. The next closest sector was consumer discretionary, which was up 2.3%. So it had a massive outperformance relative to the market and relative to the closest sector. Why? Your material sectors, they're going to track things like, Freeport-McMoRan and Newmont Mining, a lot of those instruments, which did really well last week. So as a whole, materials were on fire, and they eased a bit today, down, 73 cents on a $96 stock or so. So we eased by maybe just under 1%. Which, I don't think that should surprise people. You get these moves, I don't want to call it parabolic, but materials don't tend to move with that level of sort of, 3.5%, and the overall market was only up 2/3%. That's massive outperformance, and it shouldn't surprise people that you see some rotation out of those names to get portfolios into better balance. And I think that's basically what we're seeing here today. Couple that with the fact that gold was fairly weak. Backed off highs for the last couple of sessions, and I think you've got your story for why you're seeing a little bit of weakness in materials. I don't know that it's enough weakness to try to take on new positions. I've collared a lot of my materials, so a lot of those not collared. Yeah, I've collared a lot of the material stocks. So Newmont Mining, Barrick, GDX, GDXJ, which are the gold miners and the junior miners. I've collared a lot of that stuff. And so my general position, I know some of you guys are volatility sellers. I like to play that game sometimes, but I also like to add just net longs to a portfolio when stuff gets cheap. And I know cheap is relative, but for me, so I've had these miners for a while, ever since Druckenmiller reported a big position on Newmont Mining earlier in the year. I started building a position on a lot of these miners, and they've done well. And rather than starting to sell this stuff, because if you look on a short-term time frame, and this is going to be the same thing as your Chinese stocks, same type of story. If you lock yourself into one time frame, you could look at this 1-year daily chart and you could say we're at price extremes, right? Very easy to say that. But if you look at these instruments over a longer period of time, I always do this, and it ruins the point I'm trying to make. So Newmont Mining is a good example. Over a 1-year time frame, you look at this and you say, all right, we're at price extremes, but over 5 years, it's a very different story. You're only mid-range relative to the highs, and Chinese stocks are going to be the exact same, right? If I look at something like probably Alibaba, we look at a 1-day time frame, it looks ridiculous, or 1-year time frame, it looks ridiculously expensive, right? But if we look at a longer term time frame, you can see on a longer term time frame, this doesn't give you the same story. My point is, so on some of the things that I don't think are at absolute price extremes, they're at short-term price extremes. I like to collar that stuff. And then if we end up getting a break in price, what I do is just basically take off the hedges, so sell the long puts, buy in the short calls, and then add to the position at lower prices. So that's the way I try to navigate the world. More often than not, it doesn't work the way that I had hoped. More often than not, what happens when I put on a collar is the stock shoots above my short call strike, and I'm buying in calls. and rolling them out. That tends to be how this playbook works. But every once in a while, stock goes down while you have a collar on, and you end up feeling smart, like you're. Who's the famous guy who put on the collar on his stock before the 2001 crash? Mark Cuban. That's why Mark Cuban's like considered. That's what he's famous for. He just put on a collar, and he kept a lot of his equity through the .com bubble bursting. Anyways, so that's the material story. The second best performing sector last week was discretionary, and I'm sort of scratching my head about that. And especially with the potential of a port strike here, as we get into that, and I know the impact of the port strike is really going to be time dependent, right? If they work it out in a couple of days, we're not going to see that much of an impact. But it's sort of like exponential. Each week this goes on, the more impact we could end up seeing from this port strike. And I had this conversation before we went on air with Tom yesterday at First Call. And if you don't watch it, basically every Sunday evening at 5:00 p.m. The futures open, and Tasty does a futures open show on Sunday night. If you weren't aware, it's called First Call. And before we went on air, I had a conversation with Tom, and I said, what do you think the impacts are of the port strike? And he goes, it's priced. That's what an efficient market theorist should say. And I go, I know it should be priced, right? But I looked at everything I could think of. Like I looked at the shippers, like SBLK and a handful of others. Maersk is not. I think it trades over the counter in the U.S. market. So I did as best as I could. I look at Walmart. I look at Costco because they're highly port dependent. I look at the shippers. I don't really see anything going on there. I'm like, I know this should be priced somewhere. It's got to be discounted in some way. And I look at the individual implied volatilities, and I see higher implied volatility for this week than next week. You tend to only see that when something has earnings or when it has an event that is driving up demand in the short term. Normally, vol is synthetic time. So the more time you have, the more time you have something to go for something to go wrong. The broader, the wider the distribution curve, so the higher the implied volatility. So if you look, put this week aside, and then you should see what is normal is we go up in vol as we go out in time. That's not necessarily the case in the front month for some of these instruments. And so I'm like, all right, well, maybe that's where the potential of these port strikes is basically showing up. But I did notice today when I started to really think about it, the second thought that I have is maybe I shouldn't be looking at the top tiers, like the Walmarts and the Amazons of the world. Maybe I should be looking at like the lower end retails. And I saw today, again, this is multi-factor, right? This could be many different reasons, but I did notice Dollar Tree got absolutely smoked today. So I wonder if some of that has to do with pricing in the potential of this risk. Let me ask the chat real quick. What do you guys think about the potential impacts, whether it's risk or opportunities for the port strike? Do you have trading ideas around the impact of this? I normally don't like to think this way, because these things are generally priced, and I'd rather be talking about events that are 6 to 9 months off and thinking about how to price those things. I think there's more opportunity in that type of stuff. But something about this bugs me. It feels like we're very complacent around the potential of this, and it seems much bigger to me than the market reaction and response. Tell me if I'm crazy. Do you guys have where do you see it priced? Do you see it priced, and where do you see risk and opportunities in underlying instruments? I'll come back and I'll read your responses in just a little bit. But one of the other things I noticed about last week, as we get into this week, and we'll start to set up what to expect for this week, but I had a couple of themes I wanted to cover. And now that we've got 90 minutes, I don't have to rush through these things. I can take a little bit of time to expand. I also noticed that not only was Tesla, it's had this nice little run, but you also saw a resurgence in solar instruments and a resurgence in basically the whole clean energy theme. So Tesla was higher last week, but TAN, which is, if you can remember, everybody was trading this stupid ETF back in 2020, right? When everybody was going crazy and COVID money was all over, liquidity was just all over the place. I remember every millennial was talking about trading TAN and PBW, right? And both of those things had a pretty decent week last week. TAN was up like 5.75%, and PBW, which is basically a clean energy ETF. All these themed ETFs have everyone threw them in the trash since 2020, but this themed ETF was up 5.5%. And, so some part of me wonders, is that real? Have we just thrown out the baby with the bathwater on some of these themes? Or is this a bit of, short covering? Because you can't tell me that if you look at these Chinese stocks, like, this doesn't happen just because people change their minds that quickly on the valuation of securities. Like, I get it. The PBOC sort of did an about face with monetary, but I think for the most part, the market saw that coming. That was a known. It was just at what point, and then how big would the monetary stimulus be? And same thing with the fiscal package, right? The $284 billion in sovereign bonds, something like this. That's not huge, but it seemed like it was enough to cause a massive short covering rally. And so there's a part of me that is looking at some of these, this TAN and PBW, some of this stuff. Are people getting excited about these themes again, or are we seeing a bit of short covering now that there's rising liquidity and more, liquidity type events that are happening in the marketplace? Do you want to get caught short in that environment where we're now in an easing cycle with added liquidity from central banks, both domestically? We're not adding, I shouldn't say that. We're adding fiscal liquidity. That's probably a rough place to get caught short. And I think anyone that was short Chinese stocks, they're learning that message. They took a lot of pain. And I wonder if some of these rallies are not more short related than they are people getting excited about the clean energy theme. But it was across the board. All the stuff that all the stuff that we've been talking about. Albemarle had a great week, back up to near $100. And this is one of the largest lithium providers, and we're in a lithium glut priced out for the next couple of years, and everybody tells me that, right? Don't put your money in Albemarle because there's a lithium glut, meaning there's oversupply. But to me, I go, isn't that when you want to start accumulating a position? Because if I'm accumulating a position when we're short lithium, well, Albemarle's going to be in the clouds then, because the market's going to see that coming. So this is what we've been doing on this show. When nobody was talking about nuclear, we were adding adding some positions in nuclear. When everyone threw out the whole electric vehicle investing theme, we started accumulating Tesla. We started accumulating a little bit of Albemarle. I'm probably mispronouncing that too, by the way. I remember the first time I said, I think my first day as a licensed representative, I was just giving quotes on the phone. Somebody called in, they said SLB. And so my first quote as a licensed representative, the guy asked for a quote on SLB, which is Schlumberger. And I mispronounced it as Slumberger. And nearly 20 years later, I still haven't forgotten that mistake. You ever make a mistake and then you think about it sometimes in the shower and you're just like, oh, why did I do that? That's one of those. Anyways, let's keep cruising here. We talked about 210. A couple of the other pops. So Wynn Resorts had a massive week last week, up 22%. Same thing with Las Vegas Sands. And this is the type of stuff that, like, scares the hell out of me. You know, it scares the hell out of me that these instruments can move that much. You know, Nvidia on earnings adding hundreds of billions of dollars in market cap. Meta, Las Vegas Sands, Wynn. I mean, these stocks are just hockey sticking. And some of that might be a feature of maybe a bear market rally or just massive short covering. But I'm starting to see this stuff all over the place on all of these charts, just straight up hockey sticking. Am I the only one who gets nervous when I see stuff like that? Same thing with Micron, but at least you had a catalyst here. With Wynn and Las Vegas Sands, that looked like it was related to basically the China story. They've got a lot of Asian exposure. So it's in David Tepper on CNBC had mentioned that those were some of his China-related plays. He made he was very bullish, saying he was making big bets in China. And he called out Wynn in Las Vegas Sands explicitly, and those things went gangbusters. At least Micron had earnings, right? Micron had earnings up 18%, so at least there was a catalyst here outside of some guy talking about a stock on CNBC. But Albemarle was up 12%, as I mentioned, and a few drops from last week. None of them I picked up. I want to ask you guys if you picked up any of these. So the drops from last week, Jay Wright saying, I get nervous too. Absolute beginner, hyperinflation charts. That's what I'm saying. That's exactly what I'm saying. Like, to me, I go, is that a company becoming more productive? I don't think so. I don't think that's what it is. Is that a bunch of people all of a sudden for the last quarter going gambling, or a bunch of people changed expectations about how many people will be gambling in the next 6 to 9 months? I don't think so either. To me, this stuff is telling you, I don't think this has anything to do with, this has nothing to do with growth or changes in future expectations of growth or revenue. To me, this has everything to do with liquidity. And same thing with this. This is changes in liquidity expectations. But that's not the story, right? That's not what everyone else is saying. They're, I don't know. I got to take off this tinfoil hat one of these days and just start participating again. But I can't do it because I know the truth. SMCI was down. SMCI was down 8% last week. And every once in a while, we like to get crazy on this show. Like when Intel was in the dirt, it's a horrible company being kept alive by basically just free government money and taxpayer dollars. But at some point, it got cheap enough for us to take a shot and sell some out of the money puts. We got paid on it. So then the question is, even though this company is cooking their books in a giant scam, is it cheap enough, or is there enough implied vol for us to get interested? The answer is no, not enough implied vol relative to itself. It's only an Ivy rank of like 40, as you just saw, but it does have individual implied volatility of 90%. I always think that's sort of interesting, right? Because it means you can basically you're going to trade at zero. 100% implied vol means within a year's time, the market says this could either be zero or double. And I start to, those types of risk to reward bets are interesting. But I don't think this has, I don't love, those 290s are kind of interesting, huh? A 10 delta for $8. You got to take on a bunch, because it's an expensive stock though. So you'd have to do a vertical with this. And the markets aren't too wide, but they're not great. Anyways, the point is that the only really big drop from last week, there was SMCI. This is the biggest one. Marathon Oil, I thought, is a higher beta energy name. So when energy companies start moving, this thing tends to outperform just because it has a higher beta. So if a rising tide lifts all boats, all else equal, assuming the market wants beta, because sometimes they want value over beta or value over growth. But all else equal, when energy starts moving to the upside, this will outperform. Well, energy didn't move to the upside. Like that was last week, or excuse me, that was 2 weeks ago. Last week, you actually had energy doing the exact opposite. It was down. XLE was down 1%. So then your higher leverage or higher beta instruments are going to underperform. And I think that's part of the story here for MRO. It underperformed last week when energy sort of took a breather because 2 weeks ago it was on fire. Here's 2 weeks ago. You can see what Marathon did, 26 up to 28. And it just reversed it last week. All right, there's my pops and drops. Let's get going to the earnings calendar. We talked about the yield curve. Let's see what you guys are squawking about. Who gives? You play the stock data regardless of PE, or if you think it's a crappy company. I know that you guys are probably having a conversation in the chat here. If I could offer my thoughts, I don't make individual buy and sell decisions on PE. But like I won't short something because something has a high PE. I'm more likely to be interested in buying something that has a low PE on a relative basis. But I won't short just because something has a extended PE. There's got to be other factors. So this week's earnings, I'll go over them really quickly. Carnival Cruises was this morning. The winner was the short vol trade because it basically traded a little bit down, but not by much. CCL, yeah, down 13 cents. So it had a long tail, but really the short vol trade was the winner, not bulls, not bears. And I think tomorrow, after the close, is probably the biggest and most interesting of all the earnings events this week. So it's Nike. Nike is in the middle of a CEO transition, which is why I think this one becomes a little bit of an interesting game theory. The game theory is historically, this is an opportunity. Like Boeing did this exact same thing. When they fired their CEO, they completely couched their first earnings report. And just like from a game theory point of view, a new CEO can get the market expectations on the floor. It's easy to jump over an envelope. So just game theory says that a lot of the times you tend to see a sort of a couched earnings report on CEO transitions. I have no data to support that. That's just my anecdotal evidence and what I've seen over time. But I could be proven wrong with actual data. So the game theory here is, as you go into Nike, the new CEO takes over, I believe, on October 14th. And so, is this an opportunity to do some crazy write-downs or lower street expectations ahead of that CEO transition? I asked that question to Tom in yesterday's first call, and he said no. And the reason he said no made a lot of sense to me. He said, if you look at what the market has done since the new CEO announcement, so you've gone from $75 stock basically up to $90. He's like, the market's already telling you it has raised expectations. So it's going to be really hard to get those expectations back down. And why would you want to do that? You would want to go with the momentum that the market has given you. And I think that makes a lot of sense. Regardless, I don't think that should impact the way anyone trades. I just think it's sort of an interesting aside as we go into tomorrow's earnings event. Implied vol is relatively high, 70 IV rank. So I think this one's interesting. I think I want to play this one to the upside. I think I want to play it to the upside, even though it's weird though. Because what could they say about the future, right? We're in an uncertain environment. So it's really hard. I think it's really hard for any consumer discretionary company to get bulled up on the future. But if I had to do anything, I think I would play this slightly directionally biased to the upside and be risk defined. I don't think I want to get caught short naked risk on either side, especially with all the hockey sticks in the marketplace. I don't want to get caught naked short anything. Forget about the news. Nike T equals 158. You think so, Kimberly? 158. That is aggressive. I would play this slightly to the upside. We shall see what happens. What do you guys think? Are you selling vol? If you're selling, what strikes are you selecting? If you are directionally biased, tell me which direction are you biased going into this earnings event on Tuesday. I will play it really small, and what I would really hope for is, for whatever reason, if Nike gets a bit cheaper, if it gets sub 80, which I think is unlikely because the expected move I think was like $8, $5, 580. So I think it's unlikely it gets below 80. But if it gets in that range, I'd probably start adding something. The move is DKS. Interesting. The other one is Foot Locker. Yeah. To me, I just think we're in a period where the mid cap names, and theoretically, if we're right about where we are in the cycle, the mid cap names start doing really well in this part of the cycle. Mid to small cap names. Without it to small cap, you got to be careful because you don't want small cap names that have high leverage or high amounts of debt. But this part of the cycle, you got to watch those mid cap and small cap names with decent balance sheets. This is the part where they could hockey stick for the right reasons. Absolute beginner. Venezuela stocks are the best. Oh, that's good. All right, so that's our earnings calendar. There's a few others, McCormick ConAgra, which is a staples company, on Wednesday, and then Constellation Brands, which I think actually has a pretty decent implied move. So STZ. ConAgra, it's not worth talking about. It'll be a headline because it's a big company, but those staples companies are the most boring to trade binary events. They have 2 to 3% implied moves. It's just not worth the risk ever. So it's not worth talking about. Constellation Brands, though, yeah, $8. Yeah, even that's pretty weak. That's like 3 or 4% too. So nothing there. Let's talk about earnings the economic calendar, the setup for the week. I got the right one up? Yes. Okay, we got the right one up. So we had Chicago PMIs this morning. It was a little bit stronger than expected, and Powell's speech. So I think the takeaway from Powell's speech, if you didn't watch it, the biggest part, and I can show you exactly when he said it. Let's go to our 30-year. Let's go to the bonds. We'll go to 5 minutes. Here we go. And this is when he was talking, and this is when he said something important right here. And you can probably see that in all of the maturities. I bet if I go to 2-year, it'll be even more pronounced. But basically, there it is. Boom. You can tell exactly when he was speaking and when he said something important. So he basically told the market to not expect 50 basis point moves, to expect 25 basis point moves going forward. And I think that dampened current expectations that that they are going to aggressively cut and continue to move at 50 basis point clips. I don't know. I think that's just, I think this is all gamesmanship, right? They're snake charmers, and they want to charm the 2-year a little bit higher, right? Because the lower that thing goes, the more that the market is going to pressure them to continue to cut at an aggressive pace. So I think they say what they can to try to get the market to respect their desired path. But if the 2-year doesn't play ball, if it goes lower than 3.5, then the market's going to pressure the Fed to move, and if they don't move with the market, so the market's telling them this, but the Fed does something else. That difference in expectation is when you get market volatility, right? If you go back and you just think about it, when we started the cutting cycle, or excuse me, when we started raising rates, remember the market was like, maybe they'll raise rates 3 times. Like honestly, they thought they would raise rates, and me too, 3 or 4 times in a year, which was basically we'd be at 75 to 1% in the Fed funds rate, and they jacked them on everybody up to 5. And what do you get? The natural result is vol. When we came into this year, what did the market say? The market says you're going to cut 6 or 7 times. Fed says no, we're not. And so you didn't necessarily see downside vol. You saw upside vol. No, you saw downside vol. So when they priced 6 cuts, market starts running in October, November. April, they start to ease off March and April, they start to ease the market off those expectations. You see downside vol. So when the Fed doesn't want to do what the market is pricing, those are environments where you can potentially see volatility because the market has to true up what they've priced to what the direction the Fed's going to go. And if you don't want to have an aggressive cutting cycle, well, you've got to talk the 2-year up, at least to keep it stable. And I think that's a bit of what we saw today. And I think we should continue to expect that. But the question becomes whether or not whether the short end continues to listen. If that thing continues to plummet, then you know what the Fed's going to do. And if they don't do it, you can expect a lot of volatility if they fight the market. At least that's the way I see things. So tomorrow, it's a pretty big day for week. Good Lord. It's a pretty big week for economic data. Tomorrow we have the ISM manufacturing index. We have construction spending. But more importantly, in my personal opinion, we've got jolts, Fed squawkers all over the place. These are just big landmines. I'm trying to skip them. Motor vehicle sales on Wednesday. So all of your, Tesla, GM, and Ford, if anybody's trading those anymore, Toyota, Honda, Ferrari, or not Ferrari. What's the... Gosh, I forget, but it doesn't matter. All of those names, even the Chinese EV names, I think those are all going to be in play on Wednesday based on what these numbers are. So be ready for that, either for risk if you have existing positions or opportunities. And we get ADP on Wednesday, EIA petroleum status report, which was a draw last week. And again, Thursday, claims, which can always create a little bit of volatility. Stellantis, thank you, and Ferrari. That is the one I was looking at. Race, yes, thank you very much. An interesting name, but not a ton of liquidity in Ferrari, unfortunately. ISM services on Thursday, and again, a bunch of tape bombers that could say and do anything in the afternoon. Me personally, I don't think you have to listen to these people, because they will just say anything, but you do have to be ready for any of these people to say something meaningful, which could impact the curve, right? That's exactly what we saw today. Jerome Powell kind of tape bombed on the curve, which then created downside in the equity market, because if you have higher interest rates, you have to factor that in to discounted net present value of future cash flows. So the market did that whole dance. But they bought them up anyway. Any discount, they're just buying this stuff up because we live in Venezuela. And then Friday, the non-farm payrolls report. And I think the consensus, let's look at it, but I think the consensus is 144,000 jobs, 4.2% unemployment. Oh, this one's different. So I had seen coming into the week a different source with 144,000. This one's got consensus at 132,500. So you can see now that they've, now that we trued up and we acknowledge that we had overstated half of the jobs over the last year by 818,000. It seems these numbers are a lot more reasonable all of a sudden, right? That birth-death model doesn't work when you're at inflection points in the economy. And perhaps that wide difference between what the actual payrolls were and what we reported them at is a flashing red sign that we passed that inflection point. I know we all know this, like we're headed for slower growth, but it's just confirmation that that birth-death model is horrific at the inflection points, that both the start and the rollover of an economy, and overstating by 800,000 jobs is the like the emphatic stamp that was the case. Again, consensus 132,000, no expectation for an uptick in unemployment. So an uptick in unemployment would be a surprise. But let me ask you guys, absolute beginner, I'm laughing at that Venezuelan joke. Somewhere somebody gets my sense of humor, like this dry sarcasm. And if you get it, these are just for you. It's going to go not over their head because it's not very sophisticated or intelligent, but it's going to go right by 95% of the people. But a couple of you are going to snicker while you're listening to this. But here's my question to you. If there's an uptick in the unemployment, and remember the summary of economic projections put out by the Federal Reserve expects, whatever that means, the unemployment rate to get up to 4.4% in 2024, right? And we only got a couple more payrolls reports until the end of the month, or until the end of the year, and expects for all of 2025 that 4.4% will be the high. I don't think that's true. I think we'll be somewhere closer to 5%. And that's just a guess. But if we see high upticks in unemployment, I am curious whether you guys, ceteris paribus, single factor alone, do you think that's bullish for equity assets or bearish for equity assets? I want to see what you guys think. Again, the question is, would a slight uptick, so a surprise uptick in unemployment from 4.2 to 4.3%, would that be net bullish for equity risk or bearish for equity risk? And my answer is actually counterintuitive. That's the reason I'm asking. So let's see what you guys say. I'll give you a beat to type in your answers, and I'll come back to this in just a bit. But the other potential here to spark something in the yield curve would be an unexpected increase in this average hourly earnings month over month. So the expectation is that your wages go up by about 0.3%. In the last report, it was 0.4%. If there is a surprise uptick in that, what does that mean? That means more purchasing power amongst the proletariat, and more purchasing power means potentially upward bias on prices, and that could potentially be factored into the yield curve or create a little bit of volatility into the treasury market. I am stumbling over all my words today, and I do not know why that is. So let's see what you guys said. Hawk Run says uptick would be bullish. VDub says bearish for now. Sterling says will be bullish as it would accelerate rate cuts. Very, very smart analysis there. Absolute Beginner says bearish, question mark. I love that. Baba, what's going on, Baba? Great to see you. Says bearish. Kimberly, thanks for being so active in the chat today. Appreciate it. Makes it fun. Says bearish. So my and Meta says, hate to say it, but net bullish because less dead weight from cynical court perspective. Boom. I sort of think a surprise uptick in unemployment would be bullish. Because why? Because one, we're below 4.4%. So the Fed has already told the market to potentially expect 4.4% unemployment. So in some way, it's being factored and priced into everything you see in your screen right now. It's not fully discounted as if we're going there, but at some level, there's price discount of that already. That's number one. Number two is higher unemployment is to Sterling's point, I think would create more more speed on the rate cut scenario. So the higher that thing gets going, the more pressure there's going to be on the Federal Reserve to respond. And then also, higher unemployment in the short run actually just means that corporations are cutting expenses. So as long as that doesn't do anything in the short run to revenues, it actually means expanding margins for the ultra short term. So in a weird way, I would be careful about thinking about higher rates of unemployment as insta-bearish. I wouldn't think about it that way in this particular environment. That's my personal opinion. I could be totally wrong, but that's the way I'm thinking about the world. Sterling says, my question for you, Victor, is this. Does the market believe jobs numbers anymore after over 1.2 million revisions down in the last 12 months? I don't know if the market believes it, Sterling. I can just tell you what I think. I don't believe that the number is right, but it's the only number that we have to trade. So it's like if we're playing poker, and the turn card comes. We can argue over whether or not the dealer dealt from the, is dealing from the bottom or something like this. It's probably not a great example, but at the end of the day, we've got to play the card that was flipped. And so I think that would be my response. I don't know that anything is purpose. Like the narrative is they're purposely that they're purposefully misreporting the payroll's information. I don't know that I don't know that I believe that. I don't have any evidence to believe that. I do know that I think there's a better way for us to have a more real-time understanding of what's happening in the labor market, given the fact that we have payment processors and we could just go straight to the source like ADP. We could go straight to the source to sort of figure this out, but we have some weird convoluted way of this model where we effectively just add 50,000. If you go look at the numbers, the birth death model basically just adds 50,000 jobs. And that becomes a real problem when there's vol to the economy or the economy does something quickly or changes directions. That birth death model either underreports or overreports, and that becomes problematic. And I think the economy shifted. I think that birth death model had a real impact into the numbers we saw every day, but it's the only number we have. And so we got to trade it. That's my answer, Sterling. A little bit long, but I will accept the poker analogy. Thank you. All right, I'm going to get off this screen, producers. Just giving you a heads up, I'm going to go back to the platform. I know you guys are doing some cropping, and I do understand why. Too much white space. I appreciate what you guys are doing. Just giving you a quick heads up. I am now flipping to the platform. So follow me there, my good friends, and great work.
Thank you.
Market staying. I can tell it's you, Matt, because you didn't go. Thank you. Which would be
I can get closer to the mic if you want, but I don't think the viewers want that.
Thanks, my friend.
Also, it is just me now.
All right, good man. So basically now that we've got this like extra long show, we've got 90 minutes, and we are now into that the extra 30 minutes here. Matt's the only one that's hanging around with us. I want to talk about a couple of things you guys are talking about, which is bullish above 5,700. Everyone is sort of talking about this level, and it played an important role today. 5,750 played a really important role. We'll give it some time to come up. So for various reasons, whether it's technical or whether it is basically the option positioning in the marketplace, 5,750 or let's say 5,700 for some people, but let's just call it a range because I don't think technical analysis works by to the penny. But the point is, within that range, that's sort of this line in the sand for bullish sentiment, bearish sentiment. And in a violation of that range, we could see the gamma of the market shift. And it could see the sentiment of the market shift with a violation of 70 or 5,700. So I I want to call out who said it. I can't. I just lost it in the chat. But whoever brought up the 5,700 number, I appreciate you doing that. But yeah, I think it becomes really, really important. And the really interesting thing today is it played perfectly off that 5,750 area. We came down. This was sort of a value area, and the market ate up risk instantly at that level. And I think, I think it basically strengthened the reliability of that being an important level today. You get to one day, we can sort of see it on a longer level. You can see the very simple, John Murphy, technical analysis that previous resistance becomes future support. So 5,700 was this real, we were in this area for like 2 or 3 weeks, couldn't violate it to the upside. We eventually go back down. This is the yen carry unwind narrative, right? Market buys up risk. We pass through 5,700, and so it becomes likely a big line in the sand for sentiment from the technician's point of view on any weakness. So I agree with that. So let me go back to the Chinese stocks, if you guys don't mind, because I think talking about the setup of coming into this week is one thing, but I think the question now becomes, how do you play these things? How would you play this? How would you play these names with an incremental dollar? And I think that's a tough one to answer, but let's try to do it here. The IV rank of these names. Look at the IV rank. 101, nearly 102. Individual implied volatility at 42%. So basically saying that over 1 year's time, this thing could cut in half. FXI could be trading it back at, $16? Or it can add $16 to the upside, that we could be trading 48, between 16 or 48 in a 1 year's time. Why? So I think this is important, right? Like I thought about this. I think about this every time I want to put a collar on. Why do I want to put a collar on? I want to put a collar on because I've likely just made a lot of gains in a short period of time, and I want to protect the gains of that move. So what do? You want to buy puts on that position in order to protect downside. And maybe you'll sell, like all the tasty traders we try to make, if we have capital outlays, we got to pay money, we want to minimize our basis. So we might sell something against it to make it cheaper, and that's the collar. But the point is, after you get these big runs, it's not uncommon to see vol go up. But it's counterintuitive, right? Because you're thinking the stock goes up, then that means vol goes down. Well, in this case, stock goes up so much that what are you likely to see? You could potentially see with every incremental dollar, somebody goes, I don't want to buy this stock because it just had this massive run. So what do I want to do instead? I want to participate in the upside with minimal capital risk on the downside. So you start seeing call options get bid up. And if you're long the stock, you want to buy puts to protect your position. And I think what you're seeing here is you're seeing increased demand for protection and for upside participation. And that's creating an expansion of vol. So I actually think the way that I would look at this, if you're not in any of these names, if you're not in FXI or Alibaba or Baidu, to me, the bid in vol in all these underlyings makes it really, really interesting to sell puts as a potential entry. Because if you do get a big pullback, that violates your short strike, you get a decent entry discounted by the amount of premium you take in. So you're not going to pay top dollar where we are now. And if you don't, you're going to take advantage of this massive bid for option premium right now, which is the whole game that we play here at Tasty. So to me, these instruments everyone's going to talk direction, right? Because they went up 20% in a week. FXI went up 15 to 20% in a week, so everyone's going to talk about them this week. But because they're talking about them, they are bidding up the demand for options, and that creates opportunity for all of us. And so I think these are the most interesting vol selling names this week. Let's see what you guys are saying. Daniel, good to see you. If it's a story, it's a fade. A reference from Tom last week. Again, I think these things could fade. I think they could fade. However, I do think over a long period of time, if we are in a rising liquidity, a market of rising liquidity, I just don't want to trade these things to the downside. I think there are some things that I want to participate on both sides of a market if I think they're close to fairly priced. I don't think Chinese stocks are anywhere close to fair value. All of these things, if you look at their forward multiples, or you look at them relative to their U.S. counterparts, they're nowhere close to being in the same ballpark. And if one day or 1 week or 1 month they want to price these things closer to fair value or closer to fair relative value, we're not close. And that's the reason I don't really want to play the short end of these things. I want to look for opportunities to get long into discounts. But that's just me. I might be wrong and these things could cut in half, but that's the way I'm thinking. I wouldn't fade these things. I think you're just asking to get murdered. You might, and by the way, you might make money. I'm not saying you can't make money on the short side. I'm just saying for me, the risk to reward doesn't, to me, I feel like it's picking up pennies in front of a steamroller. You might get a few, but, there could be a time that comes when you're like, why the hell did I even try? Collars are friction. How much are you willing to pay for a collar? Usually I'll do them at a credit reso. Like I'll sell something 45 days out and I'll buy something with maybe a few weeks. So I don't tend to do I calendarize the collar. So usually I'm doing them for decent credits. Let's see. FXI has 2 pullbacks before next advance. Yeah, I totally could see this thing pulling back, but for all the reasons I just mentioned, I would just be careful about fading. Maybe I wouldn't add, maybe I wouldn't add to a position at certain areas, or maybe I'd lighten up deltas. But on certain areas of the marketplace, this being one, I just don't want to be short some of these things. And I'll tell you why. You want to know why? Because the Venezuela charts. Because of stuff like this. This is, I don't know. I wish, when I look at this, man, I see something very different than what other people see, I think. That scares the hell out of me. And apparently it's not even a story. But let's keep cruising, everybody. What do I want to talk about? Oh, yeah. So the other one I wanted to bring up really quickly, the other article, the other theme in the marketplace, so to speak, is the nuclear. We got a bit of an advance here after being weak. Some of the nuclear stocks were weak at the tail end of last week relative to other parts of the market after they just went on this nasty run. Let me pull them up for you again. So the ones that we are tracking are CCJ, which is the largest, one of the largest uranium providers. So this is $48, and this has had a nice little run off of 36. The other ones we talk about, this is a higher beta play, and this thing just trade. If you're looking for a really leveraged, I don't want to say leveraged, a ton of beta to trade nuclear themes. This is an interesting one. This is a small SMR, so small modular reactors. And, this one has had a sick little run from 7 up to 12. Again, these, I don't understand. Nobody talks about these underlyings. Everyone's talking about NVIDIA all day long. And NVIDIA might move from like 115 to 120. Meanwhile, these other themes, these stocks are doubling, right? These Chinese stocks have gone up 50% off of their lows. FXI is up 50% off of its lows. Newmont Mining is at all-time highs. But nobody wants to talk about anything except for AI all day long. Sorry, I'll get off my soapbox. So NewScale, CCJ, URA is an ETF that sort of tracks a basket that's all related to these themes. I don't love it. I think it's a bit expensive, if I'm not mistaken. I do own it, but it's not the cheapest instrument. So the point is, we had a lot of movement on this theme over the last couple of weeks, and I don't think that's going to stop. So Microsoft bought, what was the company? How did I already forget the company? Microsoft bought an energy company, an energy name. They're reopening 3 Mile Island. There's all of these sort of movements to sort of accept that if we're going to power AI and we're going to build these gigantic data centers, well, we need energy. We need to power these things. If we are going to have digital money, CBDCs and stuff like this, every time that whole network is going to take energy. If we're all going to drive around in electric vehicles, we need energy. You know what I mean? It's so obvious. It's so obvious that we are actually headed to this world where we're utilizing AI to the extent that the narrative's being sold, and if we're going to use central bank digital currencies or digital currencies, it's going to proliferate. We're going to drive around in EVs, man. We're not even close to being able to power this stuff. They just shut down power in California. We can't even power what we've got right now. Anyways, so Michigan nuclear plant finalizes federal loan to support first reactor restart in U.S. history. This was in Covert Township, Michigan, $1.5 billion loans. And I just think we're going to continue to see this. We're going to continue to see articles like this. We're going to continue to see it's sort of like foaming the runway. It's getting people comfortable with this idea before. And now we've done it in individual municipalities and individual states. So we get comfortable and then we pass something at the federal level. That's the last thing to happen. And I think we're in a process of watching that all unfold. And for that reason, some of these uranium names are really paid. And it's been paying to buy volatility in these underlying names. And I think we'll see that. Energy prices will go to zero in 20 years. This is from Baba, or less, unless regulators protect incumbents. I think the production cost of energy will go to zero, Baba. But it's like capital. To me, I think the way to think about it, Baba, is like it's kind of like money. So some people's cost of money are near zero or inverted, right? They just have positive carry. But most people, but large institutional players' cost of money is nearly nothing, whereas the cost of money for most people right now is, depending on maturity, somewhere between 5 and 6%, and on unsecured loans, up to 30%. So I think we probably get to a world where the cost of energy has variable pricing, that's just spread between what the cost of production is and the cost to everyone else. It just ends up looking a lot like the cost of money. Let's see here. What else do you guys got? Should rephase energy production cost will go. Oh, you did rephrase it. Should rephrase energy production. You literally said the exact same thing that I said, and I just didn't read the next comment. That's funny. Daniel says it's always important to define time horizon on trade ideas. For example, Tom was saying the dollar's dead to Ilya's long dollar call. Look at today's euro pair action. Yeah, I think when Tom says the dollar's dead, he's not saying today or tomorrow or this week, right? When Ilya says he's getting long or short dollars, he's talking about hyper short term. He's talking about, literally on the charts, this moment where price is, how he would position risk. I think Tom is looking at it very differently and just saying that he sees over time a weak dollar. And I think that's in the same way that when he was going long yen, he wasn't saying the yen's going up to tomorrow. He's saying that the risk to rewards favors buying yen here. In the same way that when he was accumulating Chinese stocks maybe a year and a half ago, he was just saying they're the cheapest bargain in the marketplace relative to other instruments. And I don't think he's wrong about any of those things. The question is, when is the catalyst coming that could spark the move that you need to pay you off on the risk? And I think depending on the amount of leverage you're using and depending on the amount of capital you have, you might not necessarily care if you're on the precipice of a catalyst, right? If you got a lot of capital, you can afford to say, I'm going to buy up yen and eventually this is going to pay. That's what effectively what Warren Buffett does and value investing is all about, right? You buy what's cheap and you don't care that the catalyst may come tomorrow or 2 weeks from now or 2 years from now. You're buying what you know you're getting a value for, and that at some point in the future, you trust you'll be able to sell that at a premium. I think that's the way Tom thinks. Whereas I think many others in the active participation game, if you get a negative or adverse move inside of 2 weeks, depending on how you trade, that can hurt you. Most people are trading with their size is too big. And I think Tom's size is small relative to, the chips he's got at the table. And so it's small enough to sit on this stuff for years. And so it's time horizon, but I also think it's bet size that is important as well. How do I think about the dollar? I personally tend to agree with Tom. I think that I think the purchasing power of the dollar, we're about to see it erode, in my personal opinion, at a speed that we've probably never seen before. And we've already seen that happen. And I think unless we're willing to embrace pain as a society, it probably continues to happen. It happens at a speed we're not ready for. That's my personal opinion. But currency pairs are all relative. In the way the monetary system is set up, that doesn't necessarily mean the dollar is going down relative to the euro. And, pick your pair. So I think the dollar's purchasing power is going to erode at a speed that I don't think people are ready for. And I also think that that's why you start to see, the more we stay on this train and we don't do anything about it, the more we keep seeing stuff like this and stuff like this. And so if we're measuring our economic success by the nominal price of a risk asset, then politicians are they're going to get straight A's. If President Trump and President Biden tended to measure their economic success with the price of a risk asset, the price of the stock market, and if that's what we're going to do, that's how we're measuring economic success, everyone's going to get straight A's from here on out. And I don't know if that should be the measuring stick anymore. And we're finding out why that is right now. I think it's becoming more aware to the people how this system is working, and it's benefiting asset owners. Of course, it's not benefiting those that are wage earners solely. And we either need to get more people as asset and risk owners, or we need to, I don't want to say need to, or perhaps we continue to see social volatility manifest itself in the absence of financial asset volatility, because that's what we've done. We've essentially exchanged financial asset volatility. We do not want it, and so what do? We do all of these sort of magic monetary motion or actions, and that action protects the growth rate of GDP. But there is an externality of that. So we're protecting financial asset volatility, but Chris Cole said volatility cannot be destroyed. It can only be transmuted. So the transmuted volatility goes away from financial assets, but it manifests itself in social volatility because the method that we're using creates increasing wealth disparity and inequality. And eventually that wealth inequality shows up, rightly or wrongly, as people believe things aren't fair, rightly or wrongly. I'm not here to have that discussion. And then you start to see populist periods, populist government, populist policies. And I think that's where we are right now. Anyways, that was a long diatribe there. Sorry to get on the soapbox. Bitcoin, though, peeling off of 65. We picked up a little bit of that from, I think, 55 to, I can't remember, 57.50 or something, maybe closer to 60, and then this thing started to run to 65. So I'm just sort of praying that we get another chance at 57.5. This is another one. I don't want to get caught short Bitcoin, not in this environment ever. I want to buy it when it's cheap and maybe sell it when it gets a little bit expensive. But this is another one I think could hockey stick crazy. And I do not want to get caught short this instrument. Let's see here. Let's take as many questions as I can with the last couple of minutes. Yen is weakening again as well. I'm in the dollar rally camp. Daniel. Yeah, I think in the short term, we need the dollar to rally in order to, it sort of will minimize the impact of rate cuts and easing QT, which is likely to be the next step here, right? After rate cuts, it's easing of QT. So I do think in order to offset reaccelerating inflation or the pain thereof, a stronger dollar will help. And so I think that's likely to be the goal. Whether or not it plays or not, I don't know. Clueless but interested in learning. I'm with you. That's me too. I think it's good for all of us to think of ourselves that way. Geothermal becoming very real too. The other thing, I know I talk about nuclear energy, but nuclear energy is sort of like very far out on the time horizon. The more likely solution to a lot of this stuff is the short-term solution to a lot of this stuff is going to be natural gas. Natural gas is the bridge fuel. Nuclear is sort of the long-term bet. But I don't think it would be that crazy to start looking at, natty gas companies as well as an energy solution. Silver, I am long silver, which seems crazy because I think in the short run, we're probably a bit extended at 32. This is going to be an area we're likely to see, some level rejection. What's up with my keyboard sometimes? All right, let me try this one more time. Nothing. Okay. I swear I have used this before. First day with my new fingers. This thing is... All right, this thing doesn't want to play ball with me. I wanted to look at the continuous contract here. If you are at home, if you put a dollar sign in front of a future symbol, when you look at the future symbol, you're going to look at one individual expiration. So /SI is silver, Z is December, 4 is 2024. So we are looking at silver's December 2024 contract that expires at the end of the year. But sometimes if you're looking at trend of an instrument, it's better to use the continuous contract instead. So it will use whatever's the active expiration across your entire chart. I'm trying to get to that, but for some reason my keyboard's not working. But that's not the point. The point is 32, it's likely to be this area where we could reject before violating it to the upside, if that's ultimately where we head. If the dollar either stays or continues to weaken, we could and may violate 32 to the upside. If we strengthen here, it wouldn't surprise me if we see a rejection off of 32 and you're able to play the long side of silver a little bit cheaper. So here's what I'm doing. I actually bought some out of the money upside in silver, out of the money call spreads. And so the idea is, again, when things get to price extremes, but I think there could be a breakout, I don't like to own the underlying, especially a leveraged futures contract like silver, even the micro or even the mini /SIL. I don't want that type of risk here at a resistance area. So I buy out of the money call spreads to the upside in the event that we get follow through and breakthrough. But in the event that we don't, I have minimal risk on the table, and then I get a cheaper price to play something. If we got back sub 30, I would probably then do something more bullish. So like at the money or in the money silver options, or just play the futures outright themselves. So that's the way I play this. So I'm firing some bullish bets, but very small in the case that I'm wrong. And then if I get cheaper entry price, double down with a more leveraged bet with more capital, more risk. That's the way I'm playing it. Use AI, Victor. Your stock value will go up. Let's see here. Honestly, as AI takes off, inequality will increase exponentially. I believe it's the morally wrong avenue for humanity. Daniel, man, you would drop that truth bomb 1 minute before the close. 1 minute before the end of our 90 minutes. So I'll give you my quick thoughts. And Matt, the producer, is going to be pissed off if I go long. He's like, bro, we gave you 90 minutes and you still couldn't end the show on time. Here's what I'll say, Daniel. Here's what I'll say. I read a book by Kevin Kelly. It's called The Inevitable. And in that book, I think it's in the first chapter, he said something that really resonates with me. He effectively said that you cannot stop the advance of technology. It's kind of what we do as humans. The technological advance becomes inevitable. So while there's a part of me that does agree with you, I do believe it's going to be deflationary. I think it's going to create it's much less labor force participation. I think it's going to concentrate wealth and power even more so. I also believe it's inevitable that no matter how many times we run this game back, we probably keep ending up at this point, either sooner or later. And I also think no matter how much we try to legislate it, let's say the U.S. right now, we just outright ban it. Well, the knowledge of how to do that becomes extremely valuable to a country outside the U.S. So there's a number that somebody is going to incentivize some person or some group of individuals to come over and monetize their knowledge somewhere else where it's not illegal. So I just think when you think about the game theory behind, or the incentive behind this stuff, it's no matter how you look at this thing, it's going to happen. And so then I think rather than fight it, or sort of be fatalistic or upset about the direction, you sort of have to embrace what it is and figure out how to best position yourself in that future world. And so there's a part of me that agrees and empathizes with your position. And I struggled with this for the last 2 years, this thought of how to think about technological advance when it's happening at a speed that could create societal volatility. And the end place I got was, it doesn't make sense to fight it. It makes more sense to try to figure out how to best position myself and my family in that future, for rightly or wrongly. So leave me a comment in the comment section. Tell me how you think about AI, its impacts on society, and its impacts on you, and whether or not you choose to embrace it, accept it. Do you believe it's inevitable, or do you choose to fight it in some way, shape, or form? I want to thank all of you for sticking around for 90 minutes. I don't know why anyone would listen to me speak for 90 minutes, but I'm hoping there's a decent audience of people that want to do that from here on out. Tomorrow, we're going to have Chris Vecchio on, for a 60-minute conversation. Then I'll get to talk to you for an additional 30 minutes. On Wednesday, Ilya and I have decided to extend our conversations to 90 minutes because usually we've got a lot to talk about. We don't get to all of our points inside of 60 minutes. So I'm looking forward to this extended period of time with you guys. Hopefully you enjoy it as well. Feel free to hit me up on Twitter at Victor Jones. The Owen Jones is 0 because I like to be difficult. If you have additional topics you'd like us to cover, feel free. I've got a ton more time to expand on individual topics. I'm happy to do so. Hit the like button on your way out of the door. I appreciate you. We'll see you back here, same time, same place, same great network, only on Tasty. Peace.